When a local currency sheds significant value in a single quarter, the cost of delay is visible in every transaction. The math of depreciation is unforgiving. If the real loses 40% of its value against the dollar, a static bank balance effectively surrenders nearly half of its international purchasing power. 1 billion real drops significantly in real-world value without a single note ever being spent. This forces a different calculation for the professional trader. By maintaining an account denominated in USD or Euro, you create a macro hedge. Engaging with the global Forex market is a functional requirement for residents seeking to stabilize their net worth against the volatility of a localized economy. Reaching that market requires navigating two distinct walls. Internally, the Central Bank of Iran prohibits domestic firms from operating as retail Forex brokers, forcing traders to look beyond their own borders. Externally, international sanctions sever the link to the SWIFT banking network and lead most Tier 1 Western brokers to reject Iranian applications by default. Successfully operating in this environment depends on a deliberate arrangement of technical and financial tools designed to bypass these bottlenecks. When the standard paths are closed, access becomes an engineering problem. To trade effectively, you must manage the integrity of your connection as closely as you manage your market entries. Most trading careers in Iran are cut short not by a bad trade, but by a sudden account freeze. These are almost always triggered by the broker detecting a restricted IP address. Standard VPNs are insufficient because they rely on shared addresses. If your digital location jumps between countries in minutes, or another user triggers a flag, your account is locked instantly. The professional solution is a virtual private server, or VPS, with a dedicated IP. This establishes a permanent digital footprint in a neutral jurisdiction. Running your terminal physically close to the broker reduces execution delays from 250 to under 30 milliseconds, preventing slippage. This VPS becomes your digital foundation. It masks local infrastructure vulnerabilities and projects a stable, international identity to the global market. Technical access is useless without a way to move capital. Because of the SWIFT ban, traditional wire transfers are a closed door. Tether, or USDT, serves as the mandatory bridge. Using the TRC20 network allows for capital movement with minimal fees, independent of centralized banking rails. The process begins locally. You convert Rial into USDT through a reputable local crypto exchange, or Sarafi. There is a critical security rule here. Move the USDT to your own non-custodial wallet first. Sending funds directly from a local Iranian exchange to a broker exposes your capital to unnecessary regulatory risk. By treating local exchanges as temporary bridges rather than banks, you keep your primary capital isolated from local exchange hacks or domestic freezes. Once your connection is secure and your capital is mobile, you must select a destination. Tier 1 regulators like the FCA or ASIC must reject Iranian residents due to OFAC sanctions. You must look toward reputable offshore frameworks, like the Seychelles FSA or Mwali International Services Authority. These jurisdictions legally service international clients while still mandating capital adequacy and dispute resolution. Be cautious of firms claiming to be local branches of international brokers. These are often white-label operations with no real liquidity, simply taking the opposite side of trades. A reliable partner is identified by their history, native Farsi support, and a proven track record of processing USDT withdrawals without friction. Selecting a vetted offshore partner completes the infrastructure, allowing you to deploy your bridged capital into the global market. High-pressure economic environments create psychological stress. It is easy to fall into the trap of revenge trading to compensate for rising local costs. Professional risk management requires a 30-70 capital split. Deploy 30% of your capital to the broker for active margin, keeping 70% in a hardware wallet. This limits exposure. If a broker faces a liquidity crisis, your wealth remains under physical control. To maintain this defense, implement a profit extraction schedule. Every time your account grows by 10%, withdraw the gains back to your private wallet. These layers, the technical shield, the funding bridge, and the capital split, turn a fragile connection into a resilient business operation. Your first step is to audit your setup. Download the Iranian Traders Infrastructure Checklist below to verify your security settings and open an optimized account with FXNX today.